Good morning from the floor of the CB. This is Chris Robinson with your Traders exclusive comment today. Wednesday the 7th, the first Wednesday of this month after the long holiday weekend. Right behind me, the S&P pit. S&P and the Dow continuing to flirt with new highs. Are we going to see 2,200 in the S&P? Are we going to see 19,000 in the Dow? We got negative news with some ISM purchasing stuff yesterday, but the market held in there, and I think the story remains the same. People are chasing yield, and if the Fed continues to hold off on raising rates, you'll probably continue to see money coming into the stock market simply because it's the only game in town if you're looking for the yield. The yield on the S&P basket is around 2.5%. When you've got the rest of the world at negative interest rates, or flat like they are now, the money's going to come for the yield. The other thing we're going to talk about today is what's going on in the grains. The funds are still long soybeans. We've had some good demand action this week. We've seen this before. We get oversold and we get a good 30, 40, 50, 60, 70 cent rally in soybeans. Is that what's coming down the pike now? I would say that anytime we make new lows, it's always an opportunity for you to step in and try and look for the bounce. We've had that bounce during the past couple of days with the Chinese actively buying. However, we need to get November beans above $10, $10.20. We've seen in the past when we get to those levels, the Chinese put their hands up and then they buy the dip. So I will continue to watch soybeans. The crop conditions are good. The whole world knows we're looking at a very large crop for corn, wheat, and soybeans. If you look at the historical charts, last year we made a harvest low around the end of September, the 1st of October, and then we took off. We may be setting up for the exact same type of action. Charts are only as good as your rearview mirror. They don't always work, but I think some of the pros are looking for that type of possibility moving forward. We're going to have something that chases these funds out of their shorts. They're still short about 150,000 corn, about 120,000 wheat. So will there be some catalyst heading down the road? Well, you got to look ahead. What's coming? On the 12th, next Monday, we've got a USDA report that's setting up for, again, it could be a catalyst for a move. Always look at those reports. It's a double-edged sword, but it can give you some good volatility and give you something to play. Finally, I always like to talk about the livestock very quickly. 6 and 7 year lows in fat cattle and feeder cattle. Market's extremely oversold. The funds are still long 30,000 contracts of fat cattle. Why is that important? Well, if you get to the end of the month and we go below the dollar, which is a big psychological level in the fat cattle, you may see these funds throw the towel in and liquidate. And I can only imagine what that would do to fat cattle prices if these guys decide to flip and get out of their 30,000 long fat cattle, and God forbid they decide to get short. So if you're a producer, you really need to make sure that you are protecting your break even and know where your profitability levels are. It's one thing to hedge cattle when we're at $1.60, $1.50 where we were 2 years ago. Here we are sitting at the dollar, and I know a lot of you out there are scratching your head. If you want to talk about your hedging, if you want to talk about your speculating, look me up on the web, Chris Robinson. Have a great day.